the relation between bond prices and interest rates. If you follow news on the economy, then you would know that bond prices have been dipping even as the Federal Reserve hikes interest rates in an attempt to bring inflation under control. So why do the two work in tandem to each other? That is exactly what this video would be explaining, so watch till the end. Before you proceed, give us a second of your time to click the subscribe button. Thank you. First, let's get the definitions out of the way. Bond is a term in finance used to refer to a type of security. The way it works is that the issuer or debtor owes the holder or creditor an amount that is under obligation to repay the amount of the bond at an expected date called the maturity date. This is in addition to the interest accrued, known as the coupon, paid over an agreed period of time. Hope that was easy to understand. The coupon is paid at regular intervals, either annually, semi-annually, or as the agreement may have stipulated. Therefore, if you look at it in a way, a bond is a kind of loan or IOU. It is a method of obtaining external funds to finance for the long term. However, government bonds can be used to finance current expenditures. The yield gotten from a bond is different from the coupon. The yield is basically the returns gotten or bonds and include both the price of the bond and the coupon payment received. The coupon is rendered as a proportion of the face value of a bond. Coupons are commonly fixed, but they can be floating at times or be set at zero. In the case of the coupon being set at zero, no interest is expected, but such bonds are issued at a discount to the face value. Bonds are similar to stocks in the sense that they both have securities. They are, however, different because stockholders hold an equity stake in a company. That means they are co-owners, but bondholders are basically creditors. In that wise, bondholders have a priority over stockholders in a company. In other words, they will be repaid before stockholders. But in the case of bankruptcy, bondholders rank behind secured creditors. One such difference between bonds and stocks is that bonds operate under clearly defined terms or maturity. This is a period of time after which it is redeemed. However, stocks usually remain indefinitely outstanding. Irredeemable bonds or perpetual bonds are exceptions to the maturity feature of bonds. If you are still confused, just remember that bonds is just like a promise given to sell a debt to a buyer and to pay an interest for the debt being sold. Not all bonds are the same. There are different types of bonds, the most common being municipal, corporate, and government bonds. A lot of times, bonds can be negotiable, which means its ownership can be transferred in the secondary market. Remember that it is a debt that can be sold. Anyone that buys it is the creditor and buys it because the debtor promises to pay an interest when buying back on the debt. The moment bank transfer agent puts a medallion signature guarantee on the bond, its value becomes guaranteed on the secondary market. Different factors in bond valuation may affect the price of a bond in the secondary market and make it differ from the principal. Now that you understand what bonds are, let's get a grip on what interest rates are. Interest is a percentage of any amount lent, deposited, or borrowed that is due at a specific period. The amount initially borrowed or deposited can be called the principal. Interest rates determine the amount of interest due per period as a percentage of the principal lent, deposited, or borrowed. The total amount paid as interest depends on other factors, such as the compounding frequency, the length of time over which the principal is lent, deposited, or borrowed. Interest rates are usually calculated over a period of 1 year, which is referred to as the annual interest rate. There are other interest rates calculated over different periods of time, but the most commonly used is the annual rate. Interest rate has earned the description as the indication of the preference for a dollar of present over a dollar of future. In other words, the borrower wants the capital to meet a present need at the cost of a fee, which is the interest rate. Several factors can be responsible for the variation in interest rate from time to time. Some of the factors may include a policy directive by the government to the central bank in pursuit of certain government goals. Other factors are the currency of the principal sum, the capital's term to maturity, the probability of a borrower to default, market forces like supply and demand, the collateral value, and so on. To illustrate how interest rates work, consider this example. Company A approaches Bank B to borrow capital to fund its purchase of certain assets for its business. Bank B in turn charges Company A interest on the loan and also requests rights over some of its assets as collateral. Bank B will make use of the capital deposited by its users to offer loans to clients like Company A. In turn, the bank would pay individual depositors interest on their capital. The amount paid as interest would then depend on the interest rate and capital amount deposited. Back to the original question. What is the relationship between interest rates and bond prices? The relationship between the prices of bonds and interest rate is inverse. That is to say, when the interest rate goes up, the price of bonds would come down. On the other hand, when there is a fall in interest rates, the price of bonds will go up. Generally, bonds are held by the purchasers to maturity, but even when it is not traded before its maturity, the price of a bond can still fluctuate because of the relationship with interest rates. To understand better, follow this analogy. Assume a certain Mr. A decides to invest in a 20-year bond that has a par value of $10,000 and an annual coupon rate of 5%. While the interest rate in the market is also 5% per annum, he later decides to resell his bond holding when the market interest rate has increased to 7% per annum. Because the coupon rate is now at a lesser value compared to the interest rate, Mr. A would have to go to draw investors by dropping his bond price below its par value in order to get sales for his investments. Similarly to all kinds of investors, bond investors put their efforts in getting the best possible return on their investments. Achieving this means having to keep close tabs on the cost of borrowing, and it's always fluctuating. To understand why bond prices grow inversely proportional to interest rates, one may consider the nature of zero-coupon bonds that do not return periodic interest. Instead, this entire yield value is obtained from the difference in the purchase price and the par value expected at maturity. Here is yet another example to illustrate the relationship between interest rates and bond prices. Imagine a zero-coupon bond priced at $9,500 and with a par value of $10,000 to be paid at maturity in a year. The return rate to the bond is 5.26%. Normally, an investor would be happy to pay the $950 price for this bond with their guaranteed 5.26% return. But the investor's eventual satisfaction is still dependent on other factors within the bond market. If there should be a rise in the current interest rates and newly issued bonds are offering 10% yield, the zero-coupon bond with a 5.26% yield would lose its attraction. No investors would go for a 5.26% yield when they can get 10% elsewhere. In order to get demands, the existing zero-coupon bondholders would naturally have to beat its price down enough to match the yield return of the current interest rates. In our previous analogy, the price of the bond would have to drop from $9,500 and a yield of 5.26% to around $9,099 with a yield of around 10%. With this insight on how bond prices change in relation to changes in interest rates, it's obvious to see why the price of bonds would go up if the interest rate should drop. If, for instance, the interest rates drop to 3%, the zero coupon previously in our example with its 5.26% yield would definitely increase its attraction. The demand for the bonds will rise, thereby pushing its price up, and its yield would match the current interest rates of 3%. This would have increased its price from $9,500 to around $9,708. With the increase in price, one can understand why bondholders would have invested in bonds would always have benefit from a decrease in current interest rates. Here is a simple recap of the concepts we've tried to explain. Bonds offer a fixed interest rate which gets more attractive if the current interest rates fall and increase the demand and consequently the price of the bonds. On the other hand, if a rise occurs in the current interest rates, the lower fixed interest rates on bonds would no longer be attractive to investors, thereby causing a drop in the price of the bonds. Thanks for watching, hope to see you again.